Did you know there's a loan that lets you buy an investment property without using your W-2s, tax returns, or even proving your personal income? It sounds too good to be true, but it's actually a real loan program that thousands of real estate investors use every year. So if you've ever thought, I'd love to start investing in real estate, but I don't make enough on paper, or I'm self-employed and my tax write-offs make it difficult to qualify, this video could completely change the way you think about buying investment property. Today I'm going to explain exactly how these loans work, who they're designed for, the qualifications you'll need, and some of the pros and cons before you decide if it's the right fit for you. So let's jump in. Which loan is this? It's called a DSCR loan. A DSCR loan stands for Debt Service Coverage Ratio. It's a type of investment property loan that qualifies the property based primarily on its ability to generate rental income instead of relying on your personal income. Unlike a traditional mortgage, the lender generally is not asking for your W-2s or trying to determine whether your debt to income ratio fits within the conventional lending guidelines. Instead, they're asking one simple question. Can this property generate enough rental income to support its own mortgage payment? If the answer is yes, you may have a path to financing even if your tax returns don't tell the whole story. Now, that does not mean there are no qualifications. Your credit, down payment, reserves, and the property itself still matter. But your personal income usually isn't the deciding factor like it is with a conventional loan. Now, how does the rental income get calculated? One of the biggest misconceptions is that you already have to own a rental property with tenants in place, and that is not necessarily true. Let's say you find an investment property that you would like to purchase. After you're under contract, the lender orders an appraisal. Along with determining the property's value, the appraiser also completes what's called a market rent analysis, sometimes referred to as a rent schedule. The appraiser compares your property to similar rental properties in the area and estimates what the home could reasonably rent for in today's market. So instead of asking, how much rent are you currently collecting, the lender is asking, based on today's rental market, what should this property be able to rent for? And that projected market rent is what many DSCR lenders use when determining whether the property qualifies. So what does debt service coverage ratio mean? I know the name sounds intimidating, but the math is actually pretty simple. The lender compares two numbers, the estimated monthly rental income and the monthly housing payment. That monthly payment typically includes principal, interest, property taxes, homeowner's insurance, HOA dues if there are any, and then they divide the monthly rent by the total monthly housing payment. So here's an easy example. Let's say the projected monthly rent is $3,000 and your monthly housing payment is $2,500. You divide $3,000 by $2,500 and you get a DSCR of 1.2. That's generally a strong result because the property is expected to generate about 20% more income than what's needed to coverage the mortgage payment. What is a good DSCR ratio? In general, the higher the ratio, the stronger the file. A DSCR of 1 means the estimated rent exactly covers the monthly mortgage payment. If the ratio is above 1, the property is projected to bring in more rent than it costs each month. And that's what most investors are aiming for because positive cash flow provides more flexibility if unexpected expenses come up. Now, depending on the lender, some programs may allow ratios below 1, but that does not necessarily mean you won't qualify. However, loans with lower ratios often come with additional requirements such as a larger down payment, higher interest rates, stronger credit, or other compensating factors. So while it's sometimes possible to qualify below a 1 ratio, many investors try to find properties that comfortably meet or exceed that benchmark. One of the biggest reasons that investors love these loans is because they don't have to keep qualifying with their personal income every time they buy another property. Imagine you've built a portfolio of several rental homes. With traditional financing, every new mortgage affects your debt to income ratio, which can eventually make it harder to qualify for additional properties. A DSCR loan shifts the focus. Instead of asking whether you personally make enough money, the lender is primarily evaluating whether the property is expected to generate enough rental income to support itself. For many investors, that can make expanding a rental portfolio much more straightforward than relying solely on conventional financing. Now let's talk about some of the basic qualifications. Every lender has slightly different guidelines, but here are a few general expectations. Most DSCR loan programs require at least about a 620 credit score, although having a score closer to 680 or higher will usually give you access to more competitive interest rates and loan options. You'll also typically need a down payment of at least 20%, although putting more money down can sometimes improve your pricing. The property also needs to qualify as an investment property. This is not a loan program for buying your primary residence. You cannot move into the home after closing and use a DSCR loan as a workaround for owner-occupied financing. These loans are specifically designed for investment properties that are intended to generate rental income. So, who are DSCR loans best for? Who typically uses a DSCR loan? Honestly, there are several types of buyers who can really benefit from this program. The first group is self-employed borrowers. Maybe you own a business, you're a contractor, you're a realtor like me, or you have another business where you write off a lot of legitimate expenses on your taxes. Another group that often benefits is experienced investors. With conventional financing, every mortgage you take on affects your debt to income ratio. Eventually, qualifying for another loan can become more challenging. A DSCR loan removes much of that hurdle because qualification is based primarily on the property's projected rental performance rather than your personal income. And finally, these loans can also be a great option for someone buying their first investment property. You don't necessarily have to own multiple rentals before you're eligible. As long as you meet the lender's guidelines, many DSCR programs allow first-time investors. One of the things I really like about DSCR loans is that they work with a wide variety of investment properties. Depending on the lender, eligible properties often include single-family homes, condominiums, townhomes, 2 to 4 unit residential properties, some warrantable condos, planned unit developments. Many lenders also allow short-term rental properties. So if your goal is to purchase a vacation rental that you'll list on platforms like Airbnb or VRBO, there are DSCR programs specifically designed for that. Instead of using a traditional long-term lease, some lenders can use projected short-term rental income or historical rental data, depending on the property's location and the loan guidelines. This has made DSCR financing especially popular in vacation markets and areas where short-term rentals are common. Now, what properties do not qualify? This is where people sometimes get confused. A DSCR loan is designed specifically for investment properties. That means you cannot use one to buy your primary residence. You also generally cannot buy a home with the intention of living in one unit while renting out the others. That's commonly called house hacking. And while it's a great strategy, it's typically done with financing such as an FHA or conventional owner-occupied loan, not a DSCR loan. The lender expects the property to be an investment from day one. Can first-time homebuyers use a DSCR loan? Now, this surprises a lot of people. Yes, many lenders will allow a first-time homebuyer to get a DSCR loan, but there's an important distinction. You still must be purchasing an investment property, not the home you're planning to live in. So for example, let's say you've been renting an apartment for the past year, you love where you live, and you're not quite ready to buy your own primary residence. Instead, you decide you'd like to purchase a rental property as an investment. In many cases, that could still qualify under a DSCR program. Again, every lender has different guidelines, but being a first-time homebuyer does not automatically eliminate you from consideration. Now, can you buy through an LLC? Another feature investors love is the ability to purchase property through a business or entity. Many DSCR lenders allow you to close in the name of an LLC, trust, or corporation. For investors who own multiple rental properties, this can help keep their portfolio organized and may offer legal or tax advantages depending on their situation. That said, it's important to understand one thing. Even if the property is purchased under an LLC, the lender is still usually evaluating your personal credit score. They are not qualifying you based on your business credit the way some commercial loans work. So taking care of your personal credit remains extremely important. Now, while DSCR loans don't typically rely on your personal income, they absolutely do rely on your credit profile. So most lenders start around a 620 credit score, but in my experience, borrowers with scores around 680 or higher often have access to better interest rates and more favorable loan options. Just like many other mortgage programs, the stronger your credit, the more financing options you'll usually have. If you're thinking about investing in real estate over the next year or two, working on your credit today could save you a significant amount of money over the life of the loan. Pros of a DSCR loan. So let's talk about why so many investors like these loans. The biggest advantage is obvious. You generally don't have to qualify using your personal income, and that can be a huge benefit if you're self-employed, have fluctuating income, or simply don't qualify for as much using traditional underwriting. Another advantage is flexibility. Many lenders allow multiple financed investment properties, short-term rentals, purchases through an LLC, faster underwriting because there are fewer income documents to review, and it can also be a great option for investors who want to continue growing their portfolio without running into debt-to-income limitations as quickly as they might with conventional financing. Now, the cons of a DSCR loan. So of course, no loan program is perfect. One of the biggest trade-offs is that interest rates are generally higher than comparable conventional investment loans. Now, your credit score, your down payment, the property's DSCR ratio, and whether it's a long-term or short-term rental, current market conditions, and you'll also usually need a larger down payment than you would for an owner-occupied loan. Many programs start around 20% down, although putting more down may improve your loan terms. Another thing to be aware of is that many DSCR loans include a prepayment penalty. So that means if you pay off or refinance the loan within a certain period, often the first few years, you may owe a fee. Now, not every loan has one, and different lenders offer different options, so it's important to review those details before choosing your financing. Now let's talk about one of the biggest questions I get: how much money do I actually need to buy an investment property with a DSCR loan? And the answer depends on several factors. But for most people, there are three major expenses you'll want to plan for: your down payment, your closing costs, your cash reserves. And now let's break down each one. So with the down payment, most DSCR loan programs require at least a 20% down payment. Most DSCR loan programs require at least a 20% down payment. For example, if you're buying a $300,000 investment property, a 20% down payment would be $60,000. Some lenders may require more depending on things like your credit score, the type of property, whether it's a short-term rental, your debt service coverage ratio, and while 20% is often the minimum, putting more money down can sometimes help you qualify for a better interest rate or lower monthly payment. In addition to down payment, you'll also need to budget for closing costs. These can vary depending on the state you're buying in, the lender, and the purchase price, but they typically include things like lender fees, title fees, recording fees, appraisal costs, prepaid taxes and insurance, escrow funding. Just like with any mortgage, it's important to plan for these upfront so there are not any surprises at closing. Now, what are reserves? One thing that surprises many first-time investors is called cash reserves. Most DSCR lenders want to see that after you close on the property, you still have money available in savings or other eligible assets. And why is this? Because owning rental property comes with unexpected expenses. Maybe the property sits vacant for a month, maybe the air conditioner quits working, maybe a tenant moves out. The lender wants to know that you have enough financial cushion to handle those situations without immediately falling behind on your mortgage. Reserve requirements vary by lender, but it's common to see anywhere from 3 to 6 months of the full housing payment. Remember that payment usually includes principal, interest, property taxes, homeowner's insurance, HOA dues if applicable. Now here's an example. Let's say your total monthly housing payment is $2,000. If your lender requires 6 months of reserves, you would need to show $12,000 in eligible assets after paying your down payment and closing costs. The important thing to understand is that this money is still yours. You're not paying it to the lender. You're simply demonstrating that you have enough financial reserves available after the purchase. Now, can you use gift funds? Sometimes. Many DSCR programs allow gift funds to help with your down payment or closing costs. However, most lenders do not allow gift funds to satisfy the reserve requirement. So in other words, the reserves usually need to be your own verified assets. Since guidelines vary from lender to lender, this is definitely something that you'll want to discuss before writing an offer. Now, as far as loan options, most investors choose a traditional 30-year fixed rate mortgage, and that's usually the option with the most competitive pricing. However, depending on the lender, you may also see other choices. Some lenders offer 40-year loan options, interest-only payment options, adjustable rate mortgages. Each has its own advantages and disadvantages. For example, an interest-only loan can create a lower monthly payment during the interest-only period, which may improve cash flow. But eventually, principal payments begin and your payment can increase. For most long-term investors, a fixed-rate mortgage offers predictable payments and peace of mind, but the best choice depends on your investment strategy. Now, can the seller help with closing costs? Yes. Just like many other loan programs, sellers may be able to contribute towards some of your closing costs during negotiations. Now, how much they'll agree to depends entirely on the local market and the strength of your offer. If it's a strong seller's market with multiple offers, you may receive very little or nothing at all. If it's a buyer's market, however, seller concessions can sometimes save you thousands of dollars in upfront expenses. It's simply another negotiating tool your real estate agent can discuss with you. Now, how a DSCR loan is evaluated. Let's walk through a simple example. Imagine you're purchasing a rental property and the appraisal is completed. The appraiser estimates that similar homes in the area are renting for $2,800 per month. Now let's say your projected monthly housing payment, including principal, interest, taxes, insurance, and HOA dues, is $2,400. To calculate the debt service coverage ratio, divide the projected rent by the monthly housing payment, so $2,800 divided by $2,400 equals 1.17. That means the property is projected to generate about 17% more income than what's needed to cover the monthly payment. Now, while every lender has different requirements, a ratio above 1 is generally considered stronger than 1 below 1. Now, is a DSCR loan right for you? Like every mortgage program, DSCR loans are not the perfect solution for everyone. If you're buying your primary residence, there are usually better loan options available. But if your goal is to build long-term wealth through investment real estate, this can be an incredibly valuable financing tool. So especially if you are self-employed, you write off a lot of business expenses, you already own investment properties, you want to purchase through an LLC, you're interested in long-term or short-term rental properties. Now the biggest takeaway is this: the investment property has to make financial sense. A DSCR loan does not magically turn a bad investment into a good one. You'll still want to evaluate the property's income potential, expenses, condition, vacancy rates, maintenance costs, and your long-term investment goals before making an offer. Buying a rental property is a business decision, and the numbers should support that decision. So I hope this video helped you understand how DSCR loans actually work, because they're one of the most misunderstood loan programs available today. And they're not for every buyer, but for the right investor, they can open doors that traditional financing sometimes could not. And if you're wondering whether a DSCR loan makes sense for your situation, or you'd simply like to compare it with conventional FHA or other investment loan options, I'd be happy to help. And if you're buying here in Colorado, I can help you with both the financing and finding the right investment property. If you're purchasing in another state, I can connect you with a trusted local real estate agent that does business just like me. So click the link below, fill out the short form, and I'll personally get back to you within 24 hours. If you found this video helpful, don't forget to like, subscribe, leave a comment, letting me know what other mortgage or real estate topics you'd like me to cover next. Thanks so much for watching.
I can put you in a house on a hill, put you in a condo in the city, put you in a mansion, put you in a mansion in Miami, put you in a mansion in Beverly Hills, put you in a mansion. I can put you in a mansion. I can